If you're choosing between IVV and SPYM, tracking is not the real decision. Both give you the same core S&P 500 exposure. The real question is behavioral. Are you holding a position you barely touch, or are you using one where liquidity and execution matter? For most long-term holders, SPYM is usually the better fit. But once interaction rises, the answer changes. If you're building a long-term S&P 500 position, adding over time, and rarely trading it, SPYM is often the cleaner default. The fee is lower, and for a low interaction holder, that recurring drag matters. If you expect larger orders, more frequent rebalancing, or you care about execution quality, IVV often becomes the better fit. Liquidity can matter more than a 1 basis point fee difference. So the early split is simple. Low interaction often points to SPYM. High interaction often points to IVV. The rest of this video explains when that split holds and when it changes. First, remove the false complexity. Both funds are S&P 500 products. Both hold about 500 names. Both are designed to give you broad US large cap exposure. If your portfolio question is, which one gives me the S&P 500? The answer is, both do. It's not a quality tilt, value tilt, or equal weight decision. The portfolio role is the same. That matters because many ETF comparisons are really exposure comparisons. This one is mostly not. Once the exposure is essentially matched, the relevant difference moves away from thesis and towards implementation. That is why people often overthink the wrong variables here. They compare brand, familiarity, or recent performance noise when the real decision is structural. For a serious investor, the useful question is not, which fund feels better? The useful question is, what cost dominates in my setup? If the position functions as a long-term core exposure, the dominant cost is ongoing drag. If the position functions as an instrument you expect to touch, rebalance, size actively, or trade with more urgency, the dominant cost starts to include execution. Once you define that role clearly, the rest of the comparison becomes much easier. Now move from product description to portfolio behavior. SPYM's stated gross expense ratio is 0.02%. IVV's expense ratio is 0.03%. That gap is small, but it's real, and it repeats every year you hold the position. For a serious retail investor with a long holding period, that is not minimal. 1 basis point sounds trivial when you say it once. It's less trivial when the position is large, the holding period is long, and the fund is there to maintain exposure rather than to provide trading flexibility. This is where people often reach for the wrong counterargument. They say the fee difference is too small to matter. That is incomplete. A small recurring cost can still be the correct decision variable when there is very little offsetting benefit on the other side. For a low interaction investor, there often is very little offsetting benefit. If you buy in normal size, add gradually, and rarely sell, then you're not using the fund in a way that puts much pressure on liquidity depth. In that setup, the fee is one of the few persistent differences left, so the lower cost structure deserves the default position. But that doesn't always mean SPYM is always better. If you want to pay more for IVV, you should always be able to identify a real implementation reason. That reason is usually not performance history. Over long periods, with the same index target, you should expect these funds to be very close before small structural frictions. The more useful frame is this. If your behavior does not require superior trading utility, then paying less for the same core exposure is a reasonable default. IVV is much larger, trades more heavily, and shows a tighter quoted spread on the current fund pages. Those differences don't matter equally to every investor. They matter when you use the position in ways that make realized trading costs more important. For many ordinary retail orders, both funds are likely liquid enough. IVV starts to separate itself when order size, urgency, or interaction frequency rises. That includes 4 cases. First, large order size. If your orders are large relative to displayed liquidity, deeper secondary market trading and stronger market maker participation become more relevant. Second, higher interaction frequency. If you rebalance often, tax loss harvest with substitutes, make tactical shifts, or move size in stages, small execution differences can compound across repeated use. Third, urgency. If you care about entering or exiting quickly during busy market conditions, depth matters more than the headline fee. Fourth, allocator style use inside a retail account. Some serious retail investors still move meaningful capital, care about order quality, and want the broadest trading ecosystem around the position. So this is the correct way to think about IVV. Not as the better S&P 500 ETF in general. Its role is to provide the same core exposure in a structure with greater scale and stronger trading utility. For that investor, the extra basis point is not automatically a mistake. It can be a reasonable price for cleaner execution. Now connect the pieces. A lot of ETF comparisons stop at the expense ratio. That is too narrow for implementation decisions. The relevant difference is realized cost. Realized cost includes the ongoing fee, but it also includes bid-ask spread, market impact, and any friction created when you actually transact. That matters because the cheapest fund on paper is not always the cheapest fund in use. If you buy once, hold for years, and add in normal increments, execution friction is usually small relative to the time horizon. In that setup, the recurring fee deserves most of the attention. That keeps the answer with SPYM. If you interact with the position repeatedly, the comparison shifts. A one-time spread difference can matter less than the annual fee if you trade rarely. But it can matter more than the fee gap if you transact often enough, or in large enough size, or under conditions where immediate fills matter. So the practical formula is simple. Low interaction, prioritize fee drag. High interaction, evaluate realized trading cost. That is the full mechanism behind the decision. It's not complicated once the behavior is defined. A useful way to make that practical is to think in terms of investor behavior, not just spreadsheet differences. Two investors can look at the same fee gap and reach different answers for good reasons. One investor buys on a schedule, uses limit orders, rarely sells, and wants the lowest recurring cost on a position meant to stay in the portfolio for years. That investor is not demanding much from the trading layer. In that setup, paying less for the same broad exposure is usually the cleaner implementation. Investor 2 may still be long-term oriented, but the position is touched more often. There may be larger reallocations, more frequent rebalancing, more account movement, or a stronger preference for the deepest available liquidity. In that setup, the trading layer is not incidental. It becomes part of the realized cost. That is the practical distinction. This is not a debate between a good fund and a bad fund. It's a question of which friction is more likely to matter in your actual use. For many serious retail investors, the mistake is not choosing the wrong ETF once. The mistake is using a holding tool, like a trading tool, or paying for trading utility they don't actually need. You stop reacting to tiny performance gaps, brand preference, or headline fund size. You look at the role, the interaction pattern, and the dominant cost. A few things can change the answer at the margin. One is platform or account constraint. If your brokerage offers fractional shares, automated investing, or better operational support for one product over another, that can outweigh a tiny structural difference. The same is true if one fund integrates better with your existing workflow. Another is tax or transition cost. If you already hold one fund in a taxable account, switching just to save 1 basis point can be a poor trade if the sale creates a meaningful tax consequence. Structural neatness is not enough. The transaction cost has to be worth paying. Another is simplicity across account types. Some investors want the same ticker everywhere to reduce monitoring friction. That is not a theoretical advantage, but it can be a valid implementation preference if it leads to cleaner execution of the actual plan. Now for what to ignore. Do not treat tiny short-term performance gaps as evidence of a superior portfolio outcome. With comparable S&P 500 exposure, small differences over short windows can come from normal tracking variation, timing, or cash drag. They don't usually overturn the main decision. Do not confuse size with automatic superiority. Large scale is useful when you need liquidity depth. It's not a universal reason to pay more. Do not confuse lower fee with universal superiority either. Lower fee is the correct default only when the position's main job is exposure maintenance. And do not force a false binary. They are both credible core holdings. The practical question is which structure fits your behavior more cleanly. If this is a long-term core S&P 500 position and you won't interact with it much, SPYM is often the cleaner default. The lower fee is small, but it is the persistent cost that remains attached to the holding. If you expect larger orders, more frequent rebalancing, tactical use, or simply want the deepest trading ecosystem, IVV is often the cleaner default. The extra basis point can be reasonable when execution quality matters more than the fee drag. So for most low interaction investors, the answer is SPYM. For high interaction investors, IVV. Continue with the next video, it builds directly on this.